This tutorial called Dimensions of Life Insurance is to teach you to think a layer deeper about what the benefits of having your money invested through a life insurance policy. A life insurance company is a company that's a financial institution providing you with two sets of financial benefits. First, they provide financial products that protect against financial losses due to death, disability, long-term care, critical illness, and in some cases, claims of creditors. They have products designed for building wealth with guaranteed cash value and tax advantages that can provide education funding, lifetime retirement income, and non-recourse loans, and much more. One of the life insurance company's financial products that includes virtually all of these benefits is called whole life insurance. How does it work? Millions of people and corporations around the world own whole life insurance with trillions of dollars paid into it as a foundation. It's popular because it helps protect your economic life value and typically provides the following benefits: immediate legacy for heirs or charities, guaranteed premium payments, guaranteed cash value, tax advantages, creditor protection, varies by state or province, and opportunity for retirement income. Your premiums are guaranteed and can never be increased by the insurance company. Premiums are paid for a specified period of time based upon the policy type. You may also be able to change or reduce your premium in the future based on options within the policy. You have a guaranteed death benefit. Your premiums provide the immediate protection you seek and set for the stage for future benefits. This is made possible by combining the premiums of all the policy owners of the company where you are one person in a pool of many. We have guaranteed cash values. After the first few premiums, an ever-increasing proportion of your annual premium is credited as your guaranteed cash value. The guaranteed cash value is contractual and cannot be reduced by insurance company as long as required premiums are paid. You can choose to let these cash values accumulate, withdraw them, or use them as collateral for a loan at any time. Any loans taken are eventually repaid out of the death benefits or from cash values if the policy is surrendered. Interest on policy loans also will accrue if not paid, increasing the loan balance. But policy owners can decide when payments are made and in what amount. Care should be taken and payments of interest made to avoid having a policy lapse that could create a taxable gain. Recaptured premiums. In future years, the guaranteed cash value credited to your policy may exceed the guaranteed premium paid in that year. Also, over the life of the policy, the total guaranteed cash value may exceed all premiums paid. This illustrates that some or all of your premiums for lifetime death benefit coverage are recaptured within your cash value. Dividends and interest. These are non-guaranteed. There are two types of life insurance companies offering whole life: mutual and stock companies. Mutual companies are owned by their policyholders and operated for the benefit of their policyholders. Typically, surplus from their well-managed operations are paid to whole life policy owners in the form of dividends. Investors own stock companies and generally are the primary recipients of any dividends that are paid. Owners of whole life policies issued by stock companies usually do not receive dividends unless the insurer is owned by a mutual holding company. Interest may be paid on the dividends held on deposit by either mutual or stock companies. Dividends and interest are not guaranteed, but many dividend-paying whole life companies have paid dividends every year for over the last century. You have options for your dividends. Policyholders from mutual companies have several options to choose for their dividend payments. These dividend options make whole life policies very flexible. These options include the following combinations of the following: paid in cash, reduced premium, purchase paid up additions, accumulated interest, purchase 1-year term life insurance, pay loan interest or loan balance. Pay it in cash. You can do whatever you want with that. You can use it to make your auto payment. You can use it to make any kind of payments on there. Reduce premium. You can use that dividend to go back and reduce your premium. You can use it to buy purchase paid up additions, meaning you take that dividend and it buys some paid up life insurance, increasing the death benefit in your policy and thereby increasing the cash value also. You can use it to accumulate that interest. It can stay in an account and the insurance company will credit whatever interest their general account is earning. You can use it to purchase 1-year term life insurance. What if you got diagnosed you're not going to live a year? You might want to use it to boost your death benefit for your heirs. You can use it to pay interest or loan balance on it. If you have a loan on there, you can use that dividend to pay the interest or use the dividend to reduce the loan. So let's kind of take a look at what this insurance policy is going to look at. They all kind of work the same. I'm particularly taking this one for an individual at age 35. It doesn't matter if we start at 35, 45, 55. It works the same. First, you got your guaranteed premium. This can never be changed by the insurance company. Next, you got the guaranteed cash value. As you see, as you put more money in, it starts to accumulate on the guaranteed. This is the guaranteed portion of it. As long as you make these premium payments, this guaranteed portion is going to be there for you. Then you have a guaranteed death benefit. As you can see, as long as you make these premium payments, this death benefit can never go down. Then you have dividends. These are not guaranteed, but once they have been paid, they are guaranteed. You can see they start to increase over time. The dividends plus the guaranteed cash value will give us the non-guaranteed cash value. So once those dividends are paid, it can never be taken back away from you, which causes increasing death benefit over time. That's the way this particular policy is structured. Overview. Whole life insurance offers permanent insurance protection designed to last and provide multiple benefits throughout your entire life. The primary guaranteed features for this kind of policy are guaranteed annual premium, guaranteed cash value, guaranteed death benefit. Once paid, the value of dividends and interest cannot be reduced. Guaranteed annual premium. The original annual premium for whole life insurance is guaranteed not to be increased by the insurance company. You may be able to use dividends to purchase paid up additions that, along with the future dividends, may be sufficient to pay the policy's premiums. There also are limited pay policies whose premiums are guaranteed to last for a defined period of time, 10 years or paid up at 65. Guaranteed annual cash value. The guaranteed annual cash value is scheduled in your policy. Guaranteed cash values cannot be reduced by the insurance company. Based on where you live, cash value may be protected from the claims of creditors. You can access the money anytime using policy loans or withdrawals that reduce its net cash value and death benefit. Your policy can be surrendered for its cash value less outstanding loans at any time. Guaranteed annual cost or gain. Your premiums in your early years do not generate as much cash value as they do in later years. At some point, however, the policy cash value will be greater than the accumulated premiums, creating a net gain. You can see taking place here in this particular contract. Guaranteed annual cost and gain, annual increase or guaranteed cash value and annual premium. That's your guaranteed annual cost. Over the long term, whole life has a guaranteed net gain. Since whole life guarantees a net gain over time, one question to consider is, can whole life outperform other savings and investment alternatives? Guaranteed death benefit. The guaranteed death benefit is contractual, cannot be changed by the insurance company. Only a policy, loan, or withdrawal can reduce the guaranteed death benefit. The death benefit is generally income tax free and can bypass probate or increase privacy. The guaranteed death benefit provides income replacement for heirs or can be used as a gift to charities. The guaranteed death benefit can allow you a number of options to increase your retirement income streams. Overview again. While policy dividends are not guaranteed, they provide you with the ability to grow cash value, increase life insurance coverage, and or reduce out-of-pocket costs. They can be paid in cash, reduce annual premiums, purchase paid-up additional insurance, accumulated interest, purchase one-year term life insurance to increase protection, repay policy loan or loan interest. Option 1, paid in cash. Life insurance policy, you can take this dividend and do whatever you want with it. It's tax-free. Your policy dividends are tax-free unless paid as cash in excess of your total premiums paid. We're very careful to structure this that does not happen. Reduce annual premium. Can take this amount to reduce your annual premium every year. As you can see, can go down to where the cost is zero. Purchase paid up additional life insurance. As you can see, we're taking this premium, buying paid up life insurance, and you can see net cost of insurance continues to go down. So looking at this, we got a lot of flexibility built within this product. It just leaves us to our imagination, my years of experience to teach you how to make this work the most efficiently for you. Flex pay overview. This is a little more complicated. I'm not going to get in it too deeply. I'm just going to tell you that it is a strategy where you pay a smaller annual level premium than the guaranteed level premium after paying the first few years' payments in full. A policy loan is utilized alongside the dividend to help reduce your premium payments. By assessing the average dividend over the life of the policy, you may reduce your premiums in the early years and then use the anticipated growth of dividends to pay back outstanding loans over time. Failure to pay required premiums could reduce cash values, death benefits, and increase the chance the policy could lapse. By using the flex pay strategy, you can keep your whole life policy in force and provide benefits with lower out-of-pocket costs to you should you need lower premiums. It's the way it works. After you make the first couple premium payments, we start to incorporate loans and dividends and use the policy to help pay for itself. So you can see here, just going through this, we maintain a healthy death benefit, but our cost is decreasing across the board here. So I don't want to go into this because I want you to understand is that just like anything, whether you're committing to invest in a 401k plan, a 529 plan, the commitment to continue the savings going into this contract is important for you to achieve the most maximum wealth benefit. Now, this next part, I do want you to pay a close attention to because it's what I call the multiplier effect. Again, to go over into a overview, whole life simultaneously provides economic value protection as well as protecting your assets. It acts in a multiplier effect. Whole life enables other assets and financial strategies to perform better, especially in retirement. Whole life simultaneously performs functions for the accumulation, distribution, and conservation phases. These unique aspects of whole life make it one of the most valuable financial tools to own. The value of a properly coordinated whole life policy is that it can provide a death benefit to your beneficiaries while simultaneously increasing your wealth and income during your lifetime. First, we have the premium payments. Premium payments go in, provide a death benefit, and it can be an increasing death benefit depending upon how it's structured. It's going to have a waiver of disability. If you're in the working stages, if you lost your job because you were too sick or too hurt to physically perform it, your 401k stops. Where if you have that same situation with the whole life insurance policy, that premium is going to be paid by the company. That's huge. It's got a self-completing fund for disability, protection from creditors in different states, accelerated death benefits for scenarios where you may be deemed you have 12 months to live and you're not going to make it. You can use the death benefits in accelerated form, tax-free, to cover anything from critical illness situations to home health care to medical procedures. Estate distribution options. Because you got a beneficiary designation, you can name the beneficiary and it goes without going through probate to who you name as your beneficiary. Estate conservation options in order to provide for your family. There's ways within the insurance contract that you can preserve that capital for them just through the options that are available to you. Government plan maximizer. Because of the presence of the life insurance, we can make sure many times that we can wait until the maximum age to receive Social Security so that we can have more retirement income. Cash value. It's down here in this drawer. It builds tax deferred, and we have access to it immediately as it builds up. We don't have to wait until 59 and a half, or we don't have to wait for a qualified period of time. Dividend options. As these dividends come out, we're going to have options either to increase our death benefit or to make payments wherever we want that money to go. Cash value loans. This is critical. Being able to have access to capital is critical. You might remind me the next time we talk to tell you a story on a particular case that I recall. Because he had access to cash value, he was able to participate in a program that made him substantially wealthy and allowed him to retire, all because he had the availability to borrow from his life insurance policy. So the following coordinated benefits identify how a whole life policy may be used to enhance existing assets or permit certain strategies to increase retirement income, reduce taxes, provide for a future legacy, and ideally do so with no additional out-of-pocket outlay. Cost reduction. We can use dividends to make our vehicle and property payments. thereby reducing our other out-of-pocket costs. Charitable giving, because we have the life insurance, it may allow us to give to a charity because the life insurance is going to replace whatever we give to charity to our heirs. Asset pay down. What that means is when it is time to retirement, most people, what they do, they only try to live off interest. That's the most expensive money you have. Interest is fully tax deductible. We structure strategies whereby you can pay down using dividends and interest, principal and interest, thereby reducing your taxes during retirement instead of increasing your taxes. Annuitize assets. Have income for the rest of our life with no fear of running out of money. Because of the presence of life insurance, we can take assets and annuitize it so that we have lifetime income, knowing if something happens to us, that death benefit's going to come in and replace that asset for our spouses and our heirs. Pension max allows me to take the maximum pension instead of taking a reduced pension, thereby limiting and reducing my income instead of enjoying my income during my lifetime. I can afford to do that because the permanent life insurance is going to come in and replace that pension for my spouse. Retirement plan tax recapture. We have strategies where we're able to go in and reduce the overall cost of taxes on our retirement plan because of the presence of the life insurance. Income maximization. Very similar pay down strategies, being able to pick and choose when to take income from different pools of money when it's most advantageous for us. So we maximize the income benefits that we have. Volatility defense. Back in 2007, 8, and 9, when the market was crashing, people that were withdrawn from their pension funds invested in the market were taking money out of a declining balance. That is very risky. If we have cash value in the life insurance available to us, we can take it out of that and still have growth within our life insurance policy and allow our other assets to recover so we don't take them out and deplete those assets. So it protects not only income, but it protects principal for us during the times that we have real estate crashes, stock market crashes, bond crashes, so on and so forth. Collectibles, property enhancement, being able to take the collectibles that we may have. I have one family that has a train collection that's worth $150,000. Well, what he's going to be able to do at some point in time is possibly gift that to a charity, create a tax deduction, create income for the rest of his life for him. And he can do that because he's going to replace that asset with proceeds from his life insurance policy. Now that I have this life insurance, I now have permission to use my house for retirement. Take an asset that produces nothing for retirement and get a reverse mortgage, because if something happens to me, the reverse mortgage can be paid off from the life insurance proceeds. Business continuation and enhancements of business dealings, partnerships, so on and so forth. The living value of the death benefit of life insurance virtually lightens up every one of these areas of your model. Owning whole life policy with other assets demonstrates that it is more than just death protection. Owning whole life in retirement can enhance the performance of other assets, creating additional retirement income. Whole life can protect your other assets from eroding factors such as market risk, inflation, income taxes, illiquidity, and more. I hope you take the time to soak in what the power of this tool is for you and how it makes everything else in your portfolio stronger. Thank you.